responsible for creating an institutional brokerage capability for Bitcoin and other tokenized securities. Fidelity's Tom Jessup joins us now. Tom, good morning. Kate laid it out pretty well there. What are you expecting from the new administration when it comes to cryptocurrencies and regulations?
Yeah, good morning. Yes, I agree. Given Chairman-elect Gensler's experience in the space and what he's been doing in recent years, I think paints a more generally constructive attitude or picture in terms of what we might expect going forward. I would note that we saw some fairly interesting and good regulatory developments last year. You look at the OCC and some of the guidance they've given banks around access to the asset class or even participating in some of these networks. And more recently, and perhaps less publicized, some requests for comment from the SEC around better definition around what it means to be a custodian in the space, and even some questions about what it would mean for broker-dealers to transact in tokenized securities. So even predating this news, we've started to see more constructive engagement with the regulators, and we think that will persist into the new year, just given what we're seeing in terms of institutional and as well as retail demand, which was alluded to in the prior session.
Right, Tom, you mentioned Gary Gensler's track record. He's going to head up the SEC, but what did you make of Janet Yellen, Treasury Secretary's comments yesterday? She warned of terrorism risk and seemed to suggest that its use should be curtailed. Does that worry you?
It does, but I think there's an interesting report that will be issued by one of the companies that does forensic blockchain analysis, which is a tool that we rely on in terms of operating our business. And they do an annual report of call it illegal or illicit activity on the Bitcoin blockchain by actually looking at network activity. And the preview of this report is that on an absolute basis, they estimate that illegal activity on the blockchain has dropped 50% to 10 billion last year. And just given overall transaction volume increases on the Bitcoin blockchain, as a percentage of total activity, it's something like 0.3%. So I think when we think about this concern, it is a valid concern, but I think that there are perhaps other places to look and call it the non-digital economy where this activity is occurring with greater frequency and in greater size. So I would not diminish the risk, but I think the risk is potentially smaller than people might suggest it to be, and it's diminishing or declining on a year-on-year basis, which again is positive in terms of further development of this ecosystem.
Tom, do you and the folks at Fidelity have insight into what's moving Bitcoin? I mean, I can't help but notice the price seemed to peak around January 8th, which is a very difficult week for the country and stability, and it's down, what, about 20% in the last week? I mean, is this a chaos trade? Is stability bad for Bitcoin? What's moving it?
Look, I think a little bit of recent historical context is important. We doubled from September to December. We went from 10 to 20 pretty quickly. And then from early December to early January, we doubled again. So I think this is a healthy phase of consolidation for the market. I think given that, this market is still very much in its adolescence, it's hard to attribute price activity to specific factors. One interesting thing about the blockchain is that you can actually look at the data. You can see where the money's moving. There have been some reports recently that show there's actually some underlying bullish trends on the network where investors are moving coin off exchange. Typically what you see is investors move coin on exchange as a precursor to selling. So I think this is just some healthy profit taking and some consolidation. I will say that our clients, institutions that work with us, have been steady net buyers throughout this entire period, and we continue to see strong demand among institutions for access to the asset class. So that's really our perspective on what's happened recently.
Tom, so does that mean that the history of 80% declines, which it's done a few times now, was that just early period growing pains? Do you think we've entered a period either structurally or because of sentiment or flows where that's just no longer possible?
Look, I wouldn't rule it out, but I think we're in a very different market now than the one we experienced in 2017. I think the composition of investor interest has changed dramatically. We've moved from 17 a very retail-driven frenzy into the final weeks of that year, and now we're seeing much broader-based institutional adoption. You're seeing this certainly from service providers like us in our business. You're seeing this through open interest on futures exchanges. You're seeing this with BlackRock announcing that a few of their funds will have access to Bitcoin futures. I also think the market's maturing. There's more liquidity. Volatility is down about 50% from where it was in 2017. So we believe that the composition of this investor base and what's driving the market higher today is fundamentally different than what we saw 3 years ago.
Shepard Smith here. Thanks for watching CNBC on YouTube.